Good afternoon, everyone. This is Swain. I'm one of the wealth management consultants at LifeTime Asset Management. In fact, I'm the senior advisor, as you can probably tell, and that's not a title, but a description. So I'd like to welcome you to a special edition or episode of our Lifetime Learning Series. Today, we're covering a topic that I believe will be of interest to everyone. Very important topic, how the election may affect the markets. Unfortunately, this session we will not be able to take questions from the audience. However, please reach out to us if there are questions that you have, and we'll be glad to answer those. We are recording this session, so you can go to our website and rewatch it, or even binge watch all of our series on that we have done thus far, and please feel free to share them with friends and family as well. And our speakers today are Ted Cox and Elizabeth Dooley of City National Rochdale. They are, the bios I think are in front of you at this point in time. I'm going to give you a very brief introduction. First of all, Ted Cox is a chartered financial advisor, certified financial planner. He is the Eastern Divisional Managing Director for City National Rochdale and also a senior investment consultant, a BA from Cornell University and an MBA from Columbia. He's been with City National Rochdale right at 20 years. Elizabeth Dooley is also a certified financial analyst and a certified alternative investment analyst as well. And she has a degree in finance from Dublin City University. And yes, she is a native of Ireland, as you'll tell in a few minutes when she starts to speak to us. She also has 20 years with City National Rochdale. So without further ado, let's get started with Ted and Elizabeth. And first of all, thanks for being here.
My pleasure, Guy. Thank you.
Good. All right, Ted, these are some very, very interesting times, to say the least, politically and economically. And for me, and I'm sure it is true with most of our other advisors, the number one question that we're getting is, how will the election affect the markets and the economy? And I'm sure you're getting those questions too, right?
Absolutely.
So without further ado, take us into the presentation.
Thank you. I'm going to stop my video so people can focus on the screens here. And that's a great question, Guy. And I thought we would just kind of lead up to it. And, you know, that will be our only question. And we'll make it a 25-minute answer, if that makes sense. So we always want to start with where were we and where are we going to be. We think always the economy and the state of our economy has a lot to do with people's election habits. You know, when the economy is not doing well, usually the incumbent doesn't win. That's been just the history. And so we're going to talk about where we think the economy is, what we think is our objective prognosis for the election, and then what to expect as far as whichever candidate wins, what to expect economically for the next couple of years to come. So where were we? This is our speedometers. Many of you have seen this, our dashboards. This is what we thought was going on in March. And the key here is that the shadowed arrow is what was going on in February. So we can see that things like disposable income, consumer sentiment, spending, labor just fell off a cliff, something we had never seen before. And we all know why. We all kind of stuck ourselves at home and quarantine and all that kind of stuff. And we're slowly getting out of it. So this is June. The consumer is starting to figure out how to spend money. We're spending it in different places. We've got a neat chart to show that. But the disposable income is still tough. There are still about 13 million people that had jobs in February that don't have jobs now. They're being helped by the PPP and the CARES Act and things like that. We're pretty sure nothing's going to happen between now and the election for any more aid. So there's a lot of people that are going to stop spending money or just not have that disposable income to spend. we're always talking about equity market valuations. We're not going to get into that too much as a theme today, but the stock market certainly looks a bit overcooked. And then this is where we are now. So things again are getting better. One thing is this fiscal policy actually has just changed, and now it's more like there because again, it was so strong and the response was so rapid economically, fiscally, monetarily, but that has kind of fallen stale at this point where we don't expect any more aid to come. So as far as reopening, and this is the key, where we have to get back to interacting with each other, interacting commercially, economically with each other, and so we can see kind of where things are working, you know, down in Southeast and up in the North, very minor restrictions. California still has major restrictions. Some of that's due to some fires as well, which we know. So anyway, just a smattering of what's happening. This is an interesting piece because what we're seeing is that fatalities continue to decrease. And if we were to draw this chart out, I saw a chart actually that was updated this morning. Fatalities are going down. Cases might be going up, but we're getting better at dealing with it. We have hospital capacity. We have better ways to deal with people who have COVID, not cures, but better treatments. And this is seen in this chart where we go from the mortality rate. If you went into the hospital in March, you know, 12, 13% chance of a bad outcome. And now we can see what's going on in here. Again, that's because of capacity of hospitals. We know how to do it, much better treatments going on. So that's a very good sign. And even if you look at a chart of what's happening in Europe, they're having huge spikes in many countries like Spain and Italy and France, but the fatalities are still very low. So we are learning how to deal with it. This is a great one because back to school has such a trickle-down effect to everything that we do. People need their kids in school so that they can go to work. So in March, you know, everything just shut down, and now we see where we are, where there are relatively different types of reopenings, but at least some way to get kids into some sort of school activity, and so that people can go back to work. A pretty busy chart, but I wanted to emphasize a couple things. The shape of both of these charts are all Nike swooshes. They're not V-shaped, okay? So credit card spending, off the cliff, slowly coming back. What are people spending credit cards on? Not arts and entertainment, but more like general foods and things, and you know, Amazon, stuff like that. Where are people going? You may not like it, but those of you who own Apples and any sort of Google device, they're keeping track of what you're doing. And so we can see that less people are going through TSA checkpoints, more people are driving and whatnot. So this means people are interacting differently and doing different things. They're still trying to figure out how to spend money. And then one major index that people look at is what's going on with trains, railroads, and what is the average freight load coming through. And again, that is coming back. So again, it's not a V, it's a Nike swoosh is what we're calling it. We're going to kind of skip here to elections. The takeaway here is that there's very little correlation between what happens in an election year and the stock market. So if we look at election years, on average, they're pretty good. There were some great years, which means the median's up here. Year 1, year 2, year 3. So just nothing to really draw from there. And then if we look at the control of the 3 parts of government, or the House, Senate, and the White House, it goes White House, House, Senate. Again, no great conclusions here. The markets continue on. There's going to be ups and downs here and there. We know that there's going to be volatility between now and November 3rd. We know that. And a lot of that is because of uncertainty. Uncertainty is the big deal. Once they tell us the rules, a lot of people say, okay, thanks for the rules, let's move on. It's not as bad as we thought. So the uncertainty is the problem. And so the longer we don't know an outcome on November 3rd, I think the more volatility we will have. So we think it's short-term volatility. In the end, we usually will come out. And again, this was just the Great Recession back in the 2001 recession following 9/11. Okay. It's interesting what people are now focused on, right? So back in February, where we didn't really know what COVID, we knew what COVID was, barely, and things were fairly peaceful on our streets, not much going on. But you can see now it's really a third between economy, COVID, and race relations. But then if you look at swing voters, I'm not sure how many swing voters there are left, but if you look at swing voters, they focus on the economy. So that's a nice indicator of what's going on. Back to some job stuff. We talked about payrolls. Look, the unemployment number sometimes is not a good indicator because the unemployment number really only records those people who are looking for jobs, actively looking for jobs. So the folks that have just stopped looking for jobs don't get included in that number. So we look at payrolls, and payrolls are a good way to think about job capacity in our country. Are we working up to a certain level? And so when we were up here with the number of seasonally adjusted jobs, and then we went down here, so that's 20 million jobs or so. But then we're back, right? So this is a V recovery. This is coming back. How quickly we get back up to the top here, most people think, again, it's going to be a slow ride out. It's very easy for a company to lay off people. It's really hard to hire them back, or it just takes longer. And then again, if we look at where those jobs came from, this is the service industry. So movie theaters, hotels, restaurants, Carnival Cruise, and this is, again, the more manufacturing, goods producing. Both fell off, but both are coming back. A couple more things here on the economy. We look at payroll, components of the payroll, transfer payments. This was PPE, CARES Act, things like that, and this is wages. So that's a big drop for anything, especially since we see how flat it was, then all of a sudden down. So this total income that everybody has is starting to flatten out. So total income in the country is flattening out, okay? And we can see that again, that's reflected in consumption, goes down, starting to come back a little bit. Okay, the Fed has said low rates for a long time. That's a subject for a different seminar where we'll talk about investing in interest rates and where can you find yield and things like that. But lower for longer is what's going to happen. That's the Fed looking at kind of long-term prognosis for our economy. A couple more slides here, and then I'm going to turn it over to my partner, Elizabeth. We take a look at, again, objective data from Real Clear Politics, 528, 538, and things like that. Where do we see this leaning? There's a definite lean towards the Democrat. We look at what's kind of rock solid on the Democrat and the Republican, and then what's in the middle. This is obviously changing every single day, but you know, where you all are, most of you all are, North Carolina is a toss-up. It's probably tilted a little bit towards the red side. Texas is probably tilted a little towards the red side, but the fact that Texas is even a toss-up state, I think, is telling of what's going on. The big ones obviously are Florida, Pennsylvania, and then these guys up here, and they are all at this point tilting towards Biden. So you could almost say they're getting towards a light bluish color where we see that. Again, this changes every day. I would invite you to go to 538, I think is the website. They have a lot of great data on all this. That's where we get a lot of our stuff. And if we look at the Senate, it's a toss-up as well. Again, in your all home state, we know there's a fight going on there. There's a pretty good fight going on in Arizona that will have implications for the Supreme Court because that senator will get seated immediately, not having to wait till November. So just a lot going on. John Cornyn in Texas is in a fight, so lots of good stuff. And then there's the good one in Alabama, which they're really talking about who's a better football coach, And I'll just leave it at that. So again, the Senate is tightening. Our overall thoughts is that we like a split government. We would rather have, we'd rather not have it all controlled by one party. And so if the presidency looks like it's leaning towards Democrat, a Republican Senate staying at least that way would kind of prevent major things from happening. And that would, if we had a preference, if people were asking us our preference, that's what we would do. I'm going to turn this over to my colleague, Elizabeth Dooley. As Guy was saying, she's been with Rochdale, City National Rochdale, a little bit longer than I have, and she's going to take us home from here. And Elizabeth, I'll drive, so I'll go to the next page.
Okay, thank you, Ted. And I think the last point that Ted made really is the key one. So when it comes to the election, right, from an investment perspective, it's not just who's in the White House, but it's basically what party controls the House, what party controls the Senate. Do we have one party or do we have a split? And you always hear that, you know, the market likes gridlock, and that's really, I think, what we're hoping for as we move forward. One of the big questions when it comes to possibly, you know, a blue wave and a Democratic sweep is whether or not we would see any meaningful changes in capital gains rates, right? And it's always a worry that investors have. But what this chart actually shows you is that if you go back to 1955, and it looks at what was the impact on market returns the year after we had a change in capital gains. And really the takeaway is that it has not really had a significant impact on returns. And part of the reason for that is that investors, to a certain extent, they're able to control the capital gains consequences on their portfolio. And what I mean by that is that as an investor who owns individual stocks and bonds, you can, to a certain extent, control the timing. You can decide, this is a high income year, I'm going to postpone capital gains to next year or to a lower income year. Or you may say, I'm not going to take short-term capital gains, I'm going to make sure everything I take is long-term gains. And when you do take long-term gains, we often have situations where we will look to harvest tax losses in the portfolio where one offsets the other. And if you think about it, that's really one of the few free lunches that the federal government gives us, right? They allow us to offset our winners and losers. And then for situations where it is a high income year or it is a high capital gains tax year for investors, often investors will decide to make some charitable contributions, right? And you get that benefit where you can offset that charitable deduction versus your capital gain. So really the takeaway is that the headline number is really not the whole story. Ted, if we go to the following slide. So looking at the different sectors and how the different sectors could be impacted by an increase in corporate taxes, and this is the other concern. So the Biden proposal is that we increase corporate taxes from 21% to 28. And if that were to happen, that would reduce S&P earnings somewhere between 8 and 11%. But what you can see as you look at the table is that the impact will vary by industry and then also by individual company within all of the different industries. You know, we show the technology and healthcare. Those are two that could be impacted the most. But if you think of what's the reason why investors invest in those companies and continue to favor those companies? To a pretty significant extent, it's because they're the drivers of secular changes that we see happening in the underlying economy. And we still see lots of growth opportunity there. Whereas if you look at some of the more cyclical areas like consumer discretionary, financials, industrials, how well they do to a certain extent really depends on the health of the underlying economy. So if the underlying economy is doing well and consumers have more disposable income and they're more confident in their outlook, you tend to see more discretionary spending. And that's a benefit for the consumer discretionary company. Whereas if the economy is weak and people are worried about their jobs and they're worried about, you know, their future prospects, they tend to be a little bit more cautious in their spending. And you tend to see less of a focus on the discretionary names and more of a focus on the staples or the necessities. And that's why we tend to refer to those companies as being more defensive. Then on the next slide, we look at some of the implications of other policy changes that have been discussed. And for example, when we talk about the technology space, there's a lot of conversation around potential antitrust charges being brought against different companies. Right? We think the likelihood of this is pretty high because you seem to have some consensus both from the Republicans and the Democrats. But then if you think about, well, how long would it actually take to filter through the economy? It could take years. But you have that initial short-term reaction in the market because of the announcement. But then in terms of ultimately the impact on the individual companies, it could take years to play out. The other area that we see a higher possibility is in the consumer discretionary space with higher minimum wage. But if you think about it, this is something that we've already been dealing with for the last couple of years as different individual states have been raising their minimum wages. And what we've seen more and more is companies in the consumer discretionary space automating more of their process to minimize the number of workers that they need and to minimize the impact from minimum wage. And if you think about the fast food companies, right, McDonald's, Chick-fil-A, you definitely see more automation in their process. And then finally, looking at the industrials, right, you have the concern about more environmental regulation, right, that could definitely have an impact on profit margins. But I will say in terms of where we invest, we currently have a significant underweight to the industrials because those are areas that do tend to be more economically sensitive. It's going to include areas like airlines, cruise lines, right, that definitely feel this negative impact. So we have minimal exposure there, so we're not overly concerned about the impact on the portfolios. Then on this slide, we talk about some of the major policy decisions, right? So we've already touched on corporate taxes and capital gains taxes. The other concern, obviously, is higher income taxes, so increasing the tax rate at the top bracket. And that tends to have more of an indirect impact on the market, right? Because it affects disposable income, it affects consumer spending, and then it affects, you know, the earnings for those companies. But that's obviously something that we have to pay attention to. On the positive side, though, if we were to get a little bit more certainty around infrastructure and a little bit more certainty around trade policy, then that could actually be a positive for the market overall. But again, back to the point that Ted made, I mean, it really depends on whether or not we have a sweep or whether we still see, you know, gridlock between the House and the Senate. Touching a little bit on the personal income tax impact. So you can see the Biden proposal is to increase the top bracket, but that's for income over 400,000. Then also increasing the capital gains rate. But again, this is for the higher earners, right? This is for the $1 million and up households. And then also for carried interest, right? That's from hedge funds, that would be treated as ordinary income as opposed to capital gains. Probably though the biggest one for most people is the Social Security and Medicare taxes, right? That tax burden would apply to more of your overall income, right? So it's wages up to 137,000 and then wages over 400,000, right? So it's looking to catch more people in that net. Then on the next slide, we go through some of the income tax deductions. So living in a high tax state like New York, the Biden proposal is that some of the P's limitations would be reinstated on deductions. So itemized deductions would come back. There'd be no limits on state and local taxes, and then real estate deductions. And phasing out of some of the pass-through deductions that small businesses have benefited from. That could definitely be a negative for small businesses. And then they're also looking at making some changes to the AMT. Then on the next slide, we look at some of the estate tax changes. And this, for certain clients, it could be more meaningful. Right now, as it stands, the exemption per individual is about $11.5 million or about $23 million for a couple, and you get the step up in basis of death. But the Biden proposal is that we lower that back to about $6 million, and then we repeal the step up in basis. So we would say of all the things that clients should look at, before the end of the year, is really take a look at your estate plan and whether or not you need to make any changes, or if there's any benefit to actually making some gifts earlier, so you're able to take advantage of the current exemption. But again, this is going to apply to the households that are in that $15 to $20 million range. And then the other negative, obviously, is increasing the upper bracket. So we covered this already. I think this is sort of a repeat in terms of the impact, but really I think the main takeaway, and when we hear about higher personal taxes, really what we're talking about, it's the higher brackets, right? For the most part, they are trying to minimize the impact on kind of middle class households, right? So they're not feeling the impact. It's really trying to have more of the impact felt by the higher income households. And then this slide is just a more detailed comparison of the itemized deductions and what could possibly come back versus what would continue to be eliminated or reduced. So I think Ted, we'll leave it there. I'm not sure if we were opening it up to any questions.
No, I think Guy was going to kind of take it from there, maybe ask us a couple things, and so we'll hand it back to Guy.
Okay.
Okay, thank you both. First of all, we have time for a few questions. One of the questions that came from one of our advisors that suggested that it seems the big concern among many of the talking heads and analysts is not the outcome of the election, but the fact that it may be delayed for quite some time. Would you please comment on that?
I can take that, because that's something we talked about a little bit before, which is that it's the uncertainty that is the issue there. So uncertainty between now and November 3rd, and then anything after November 3rd. So yeah, that uncertainty is going to be a problem in the market, and we can see kind of the market reacting. The more it's likely that there will be some uncertainty. So I'll leave this to Elizabeth, but from an investment side, what can we do defensively to take care of that on the investment side? Not sure there's a lot we can do, but Elizabeth, what do you think?
Yeah, I mean, I think from the investment side, as you've probably seen across the client portfolios, we're not fully invested, right? We still have some cash, and that's part of the reason, right? It's the expectation of, as Ted mentioned, it's uncertainty in the run-up to the election, but then it's also uncertainty after the election until we know exactly kind of who's in the White House. And there's even the possibility, when we do know, that there could still be some uncertainty that we have to deal with. In terms of the companies that we own, we're primarily in the large cap blue chip names. We do have a lot of conviction in the names that we own. So we're not necessarily in a de-risking mode. But to Ted's point, I think it is fair to say that we fully expect to see volatility. And if you think about this year, we had a little bit of volatility at the beginning of September, not a huge amount, and we wouldn't be at all surprised to see that, or maybe a little bit more as we get through, early November and into the middle of November.
So an opportunity more than a problem, is that what you're suggesting?
Yes. And I think, Ted went over the chart that looks at, how the market has performed during all different administrations, right, in all different combinations. And I think that really is the key point, because sometimes we get so focused on the short term and the short-term volatility that we sort of miss the big picture, which is that, we want to be in good quality companies for the long term. And we don't necessarily want to overreact to short-term moves in the market, right, or short-term uncertainty in the market, because most of the time it's not related to any fundamentals. It's short-term fear. And I think it is fair to acknowledge that we're all a little exhausted after this year, right? Kind of our mental energy reserves are becoming depleted, and I think it makes us a little more sensitive to the headlines, more sensitive to the moves in the market. But we keep coming back to, we're in good businesses for the long term. We've solid balance sheets. We're not in many of the what we would say are the overvalued tech names, right? We're not in Tesla and DraftKings and a lot of those names that have run up significantly but really don't have the earnings. We're in the good companies that we think can survive through periods of volatility.
So the client that I'll protect his identity here. He may be on this call, but we'll call him Jim, that called up and says, if a certain candidate wins the selection, that he's going to go all to cash and gold. I reminded him, he said the same thing back when Obama was elected, and it turned out, obviously, we talked him off the cliff, off the ledge, and he didn't make a huge mistake. Same's true when Trump was elected. We had some people, obviously, on the other side of the aisle that said the same thing. So I think from all the information you guys have presented, which has been very, very down the middle, unbiased, in my opinion, you guys are not suggesting that anyone go to cash at this point in time, nor to gold, correct?
Correct. And I think the two examples that you gave, like it's a good reminder, I think, that sometimes we get so focused on the politics, but at the end of the day, businesses just want to know what the policy decisions are. They don't have to like them. They just want to know what they are, right? And then they can make a decision. Am I going to put my capital at risk? And I think sometimes we put a little bit too much emphasis on kind of who's in the White House and kind of what kind of an influence that has. It's definitely something we pay attention to, right? Because it impacts confidence. But at the end of the day, we try to focus more on what are the things that businesses are focusing on. Because just like the businesses that we invest in, right, we're looking at what they're doing with our capital, what's our expected return, are we getting enough return for the risk that we're taking? So we're trying to look at it along the same and using the same metrics, and to try keep as much of the emotion out of it as possible, but recognizing that the emotion can drive us. I will say to the person in terms of raising cash, if a client ever wants to take a little bit of money off the table, and it just helps you to sleep at night, we have absolutely no problem doing that. And as I said, we have some cash. If we need to raise a little more, we could raise a little bit more, but we're not recommending that you sell out entirely and go to cash.
But my comment all the time is, don't try to be 100% correct, because you may be 100% wrong.
Right. But again, I think it's also fair to say it comes back to risk profile, and we really don't know what that is until it's tested. And sometimes it's tested, right? And that's where it ties into maybe having a little bit more cash or a little bit more defensive positions in the portfolio.
Yeah. There's the old saying out there, don't fight the feds. And there's, with interest rates as low as they are, cash is paying nothing, and bonds are paying nothing plus a little bit. So, but they're significantly less volatile than stocks. So would you address that issue, if you would?
Well, I think that's really the key question for a client. Are we trying to maintain the return profile, or are we trying to maintain the risk profile? And as you alluded to, part of the challenge with trying to maintain the risk profile is that your safe investments are not really paying you anything. So by trying to maintain the risk profile, it's almost like we're paying too high a cost in terms of return. So that's really where the situation that we find ourselves in, where more of our conversations with clients relate to the difference between short-term price volatility and the steady cash flow. Because the reality is, in a low interest rate environment where there's really not a lot of good options, any investor who's trying to maintain, anywhere close to historical returns on a portfolio is being forced to take on more risk. And they're being forced because the Fed is artificially keeping interest rates low. So that's really what it, do you know what I mean? It's not that there's not a right answer, it's a series of trade-offs. And those trade-offs will differ by client, but it comes down to, yes, you're being forced to either take on more of the equity risk if you're in dividend stocks, and you're being forced to take on more of the credit risk or the risk of default if you look at opportunistic income as compared to investment grade bonds.
Well, I thought that was going to be the last question. Let me ask this one. I reviewed today with a client that has a strong value bias in their portfolio by preference, high dividends. In fact, the dividends have increased as the price of their stocks have gone down. Would you comment a little bit about growth versus value in this market environment?
Yes, so we don't actually have the slide in this deck, but it is in the regular review book. We have a chart that basically looks at the performance of the S&P year to date. So through the end of September, the S&P is up roughly 5.5% for the year. If you take the 5 largest technology companies, they're up about 40%. If you take those 5 companies out of the S&P 500, the S&P 500 is down about 2.5%. So it's definitely a situation where the headline is not telling you the whole story. And if you look at the Dow Select Dividend Index, which is all the value dividend payers, it's down about 18% for the year. So really what you've seen is a huge amount of dollars going into tech and consumer discretionary, driving the market. We had a very similar situation back in 2009, where tech was up over 60%, consumer discretionary was up 40%, and the defensive stocks lagged. But then when we got into 2010 and onwards, when investors realized that maybe the picture wasn't quite as rosy and the recovery was going to take a little longer, and we continue to be in a low interest rate environment, you started to see a lot more demand for the dividend stocks. And that's really where we think we are, right? It's more that to a certain extent, there's almost too much optimism being priced into some of the growth sectors and too much pessimism being priced into some of the value or the more defensive sectors.
Fantastic. Well, Elizabeth and Ted, we thank you so much for participating and sharing your valuable and certainly timely information with us. And I've said this before, and Ted, please forgive me, but Elizabeth, your accent gives you additional authority. So I love it.
I just have to work a little bit harder then.
Yeah, you do.
Okay.
Yeah. You need to get a true Southern accent like mine.
I'll work on that. Yeah.
Okay. Please do.
Okay.
And this is the exact reason why we started this series of presentations. Obviously, COVID has put us in a social distancing mode, but we wanted to share valuable information with our clients to ensure that we are making educated and sound decisions going forward. And obviously, this is one of those webinars. We're going to be having more. Please go to our website and look at those. I think we have a few going forward here that I'll mention in just a second. But I cannot thank you guys enough for participating and sharing your wealth of knowledge with us, and we greatly appreciate it.
Thank you very much, Guy, for having us. Thank you, Elizabeth.
You're very welcome.
And for the rest of our clients, there are a few housekeeping items here, please. We're just about out of time here, but don't hesitate to contact us if you have additional questions. You also reach out to us directly, or you can go to info@lifetimeasset.com. We have more great webinars upcoming in our Lifetime Learning Series. The current schedule is for the first and third Thursday of each month. So mark your calendars, look out for the email announcements of that. Feel free to share it with anyone else out there. Some topics may be absolutely up your alley and some may not. So go there and look. As I mentioned, these are going to be recorded, and you can go there and binge on them if you would like, or even share them with friends and family. The next webinar is going to be very, very timely for old people like me. Medicare and Medicare open enrollment starts on October the 15th, so that should be a very important and timely topic. So that's next week on the 15th, as I mentioned. Again, final thing, we're recording these things, so keep a lookout for that. And finally, thank you so much for participating. We have had a steady increase since we announced these back at the 1st of September, and we anticipate this will continue to grow to be a more important part of what we do to educate and help our clients. Feel free to share it with others, friends and family. And finally, I think Alan and Susan King are on the road tonight going to a memorial service in Ohio. We wish them Godspeed. And we know it's going to be a difficult service for them. So God bless. You guys take care. We'll talk to you next week.